This channel examines the Jeffrey Epstein case using court documents, public records, and verified reporting. We do not speculate. We do not accuse. We document what exists, and what remains unanswered. Everything presented here is drawn from publicly available sources. This is not a theory channel. This is the file. In the Department of Justice record, Jeffrey Epstein's wealth is treated as a given, not a mystery to be solved. By the time federal authorities formally document his finances, the money is already there, extensive, mobile, and largely unquestioned. This is the central tension that defines the official file. DOJ documents consistently reference Epstein as a wealthy individual, a financier, or a money manager. Account balances are noted, transactions are logged, properties are valued, but the origin of the wealth itself is never reconstructed in a comprehensive way. The record does not begin with accumulation. It begins with possession. By the early 1990s, Epstein controlled assets that placed him firmly among the ultra-wealthy. Federal filings later acknowledge accounts holding hundreds of millions of dollars, alongside complex trust structures and offshore entities. Yet there is no single document that explains how these resources were first generated. This absence is not accidental. DOJ memoranda reflect a prosecutorial focus on conduct rather than origin. Investigators examined how money moved, where it was held, and how it was used, not how Epstein initially obtained it decades earlier. Part of this limitation is legal. Financial origin is difficult to establish retroactively, especially when wealth is accumulated through private arrangements rather than public markets. Epstein's financial life, as reflected in the record, unfolded largely outside regulated structures that would have required detailed disclosure. Another factor is timing. By the time Epstein's activities attracted sustained federal attention, statutes of limitation constrained what could be pursued. Even if irregularities existed in earlier decades, proving them within legal timeframes posed significant challenges. DOJ documents acknowledge these constraints indirectly. References to Epstein's finances often appear in service of other inquiries, bail determinations, asset forfeiture considerations, or restitution calculations, rather than as standalone investigations into wealth origin. What emerges instead is a pattern of assumption. Epstein's wealth is accepted because it is observable. Accounts exist, payments clear, assets are verifiable. The system records what is present, not how it came to be. This creates a gap that defines the entire question. The DOJ record can tell us where Epstein's money was. It can tell us how it moved, but it struggles to tell us where it came from. And that limitation shapes everything that follows. When the Department of Justice record does address Jeffrey Epstein's income, it does so cautiously and indirectly. Rather than presenting a unified explanation, federal documents reference a small number of income sources that appear repeatedly, none of which fully account for the scale of his wealth. The most frequently cited source is advisory work for ultra-high net worth individuals. DOJ filings describe Epstein as a financial consultant or money manager whose compensation was tied to performance-based arrangements. In some records, this compensation is framed as unusually generous, involving percentages of asset growth rather than traditional fees. One client, in particular, appears prominently in public and DOJ reference material: Leslie Wexner. Federal documents confirm a long-term financial relationship beginning in the 1980s. Through this arrangement, Epstein gained control over substantial assets and was granted unusually broad authority, including power of attorney in certain contexts. What the record does not explain is proportionality. Even accounting for generous compensation, DOJ summaries do not demonstrate how advisory fees alone could plausibly generate Epstein's later net worth. The math is never fully presented. The assumptions are not tested. The relationship is documented, but its financial outcomes are not dissected in detail. Beyond advisory income, DOJ filings reference Epstein's use of private investment vehicles. These include trusts, partnerships, and offshore entities registered in jurisdictions known for confidentiality. While these structures are legal, they significantly reduce transparency. The record acknowledges their existence without unraveling their internal mechanics. There are also references to Epstein engaging in tax planning strategies that minimized public reporting. DOJ memoranda note that while such strategies are common among the wealthy, They further obscure the distinction between income, capital gains, and asset transfers. What is notably absent from the record is evidence of large-scale market activity. There is no documentation of Epstein running a hedge fund, executing public trades at volume, or managing a portfolio that would typically generate exponential growth. His wealth appears to expand without a visible engine. The DOJ record does not label this as suspicious. It labels it as difficult. Financial complexity, private agreements, and time all work against reconstruction. Investigators documented what could be verified, relationships, authorities granted, accounts accessed, and left broader explanations unresolved. By the time Epstein's finances are visible in federal filings, the money is already deeply embedded in structures designed to resist scrutiny. And on paper, those structures explain presence, but not origin. One of the most critical distinctions in the Department of Justice record is between money Epstein owned and money Epstein controlled. This difference appears repeatedly in federal filings, yet it is rarely emphasized in public discussion. Legally, it matters. Financially, it changes how Epstein's wealth is understood. DOJ documents confirm that Epstein was granted extraordinary control over assets belonging to others. In several documented relationships, he held power of attorney, signature authority, and discretionary control over investment decisions. These permissions allowed him to move funds, reallocate assets, and structure transactions with minimal oversight. Control created visibility. From the outside, accounts under Epstein's authority appeared indistinguishable from personal wealth. Properties were purchased, aircraft were maintained, expenses were paid. Yet ownership, in many cases, remained legally separate. DOJ filings stress this separation when evaluating liability and asset classification. This structure complicates origin analysis. When money flows through accounts an individual controls but does not own, tracing its source becomes legally and practically difficult. Transactions reflect movement, not entitlement. Epstein's financial footprint grew without leaving a corresponding ownership trail. Federal investigators appear to have recognized this limitation. DOJ memoranda note challenges in distinguishing between advisory compensation, discretionary use of client assets, and transfers executed on behalf of others. Each category carries different legal implications, and the record reflects caution rather than assumption. The distinction also affects how Epstein's net worth is calculated. Public estimates often rely on visible assets and expenditures, but DOJ documents suggest that some of what appeared to be Epstein's wealth may have represented controlled resources rather than personal holdings. This does not resolve the core question. Control does not explain how Epstein accumulated personal assets, nor does it account for expenditures that clearly exceeded advisory norms. It does, however, explain how Epstein could operate at a scale larger than his documented income. By operating through control rather than ownership, Epstein occupied a financial gray zone. He was empowered without being fully accountable, visible without being fully defined. In the DOJ record, this arrangement is not framed as illegal by default. It is framed as complex. Complexity delays scrutiny. Complexity obscures responsibility. And complexity, in Epstein's case, became a defining feature of his financial life. As investigators attempted to understand Jeffrey Epstein's finances, the Department of Justice record shows a recurring obstacle: jurisdiction. A significant portion of Epstein's financial activity existed outside the United States, embedded in offshore structures designed to prioritize privacy and limit disclosure. DOJ filings reference entities registered in jurisdictions known for financial confidentiality. These included offshore trusts and companies whose ownership details were shielded by local law. While such structures are legal, their purpose is clear: to separate assets from public view and complicate tracing. Federal documents emphasize that offshore arrangements do not inherently imply wrongdoing. They are commonly used for tax planning, asset protection, and estate management. What distinguishes Epstein's case is scale combined with opacity. The number of entities, layered across jurisdictions, made it difficult to determine how funds entered the system and where they ultimately settled. Jurisdictional boundaries mattered operationally. U.S. authorities could request records, but cooperation depended on foreign legal standards and timelines. DOJ memoranda acknowledge delays, partial disclosures, and redactions that limited investigators' ability to reconstruct full financial histories. Offshore structures also blurred distinctions between income transfers and internal reallocations. Money moved between entities without triggering the same reporting requirements as domestic transactions. In the record, these movements appear as legitimate transfers, but their economic meaning remains ambiguous. Another consequence was fragmentation. No single account reflected the total picture. Instead, wealth was distributed across trusts, companies, and accounts, each revealing only a fraction of activity. DOJ's summaries describe this as a distributed financial profile, one that resisted consolidation. What offshore structures provided Epstein was not invisibility, but insulation. Assets were visible in parts, never as a whole. Control existed without central exposure. Ownership was technically defined, yet practically distant. By the time federal authorities assessed Epstein's finances, much of the trail led outward, beyond easy reach, beyond immediate authority. The money could be seen moving, but not conclusively sourced. In the DOJ record, offshore design does not answer where Epstein's money came from. It explains why the question remains unresolved. In the Department of Justice record, Jeffrey Epstein's expenditures are among the most visible aspects of his financial life. Properties, aircraft, staff, and travel are documented in detail. Yet despite this visibility, spending offers limited clarity about where the money itself originated. DOJ filings include valuations of Epstein's residences, maintenance costs, and associated expenses. These records confirm a lifestyle requiring tens of millions of dollars annually. Aircraft operations, security arrangements, and international travel further increased the scale of required liquidity. What spending demonstrates is capacity. Epstein consistently had access to large sums on demand. Accounts cleared. Payments were made. Obligations were met without interruption. From a financial perspective, this signals stability rather than volatility. The record reflects no periods of insolvency, delayed payments, or liquidity crises. What spending does not demonstrate is source. Federal documents do not link specific expenditures to specific income streams. Payments flowed from accounts already funded, often through intermediary entities. As a result, expenditures confirm that money existed, not how it was earned. DOJ's summaries also note that much of Epstein's spending was structured through entities rather than personal accounts. Properties were held in trusts. Aircraft were owned by shell companies. Staff were paid through corporate structures. Each layer created distance between expense and origin. This structure matters legally. When investigators attempt to trace money, expenditures routed through entities are treated differently than personal spending. The record reflects this distinction repeatedly, emphasizing form over inference. Another limitation appears in timing. Spending patterns reflect mature wealth, not accumulation. By the time Epstein's lifestyle becomes visible in records, his financial foundation is already established. Early growth phases remain undocumented. DOJ filings also highlight that wealth spending does not require ongoing income at scale. Large reserves, once built, can sustain significant expenditure for years. Thus, lifestyle alone cannot confirm continuous earnings or identify their source. In the official record, Epstein's spending answers one question clearly. He had access to immense resources. But it leaves the central question intact. How those resources were first generated, and through which mechanisms, remains largely outside the scope of what spending can reveal. In the Department of Justice record, financial institutions appear not as investigators, but as partial observers. Banks processed transactions, maintained accounts, and fulfilled regulatory obligations, yet none possessed a complete view of Jeffrey Epstein's financial world. DOJ filings confirm that Epstein maintained relationships with multiple banks over time. These institutions handled large transfers, international wires, and complex account structures. On paper, much of this activity fell within parameters considered acceptable for ultra-high net worth clients. What banks saw were fragments. Each institution viewed only the accounts under its control. Transfers between entities appeared routine. Incoming funds were often classified as internal movements or client-related transactions. Outgoing payments reflected expected expenses for wealth management at scale. The DOJ record indicates that while some activity generated internal review, it rarely triggered decisive action. Suspicious activity reports, where filed, addressed individual transactions rather than patterns. Without cross-institutional visibility, no single bank could assemble the full picture. This limitation is structural. Banking compliance systems are designed to flag anomalies within defined contexts, not to reconstruct entire financial empires. Epstein's distributed structure ensured that activity appeared ordinary when viewed in isolation. Federal documents also note that Epstein's status influenced perception. Long-standing clients with sophisticated legal representation are often treated as lower risk. Assumptions of legitimacy reduce escalation. The record reflects this dynamic without assigning blame. Another factor was classification. Funds moving between Epstein-controlled entities were frequently labeled as advisory-related or internal transfers. Such designations reduced scrutiny, even when amounts were significant. By the time federal authorities examined banking relationships in depth, historical records were incomplete. Retention limits, jurisdictional differences, and time had eroded the available data. What remained was transactional evidence without narrative context. In the DOJ record, banks are shown to have facilitated movement, not meaning. They saw money moving. They did not see origin. They did not see the whole. Within the Department of Justice record, there is a striking pattern. While Epstein's money is everywhere, the source of that money is almost never the central subject of investigation. Federal actions focused on conduct, not capital formation. DOJ filings show that financial analysis was used instrumentally. Money was examined to establish timelines, corroborate movements, assess bail conditions, and evaluate forfeiture potential. But the question, where did this money originally come from, was rarely framed as a standalone inquiry. This was not oversight, it was prioritization. Prosecutorial strategy is driven by chargeability. Investigators pursue questions that can lead to indictments within statutes of limitation, supported by evidence that meets courtroom standards. Wealth origin, especially when rooted decades earlier and structured privately, offers little prosecutorial leverage. DOJ memoranda reflect this calculus implicitly. Financial complexity is acknowledged, but resources are allocated toward areas with clearer legal outcomes. Tracing origin would have required reconstructing long-closed transactions, private agreements, and offshore structures, many of which were lawful on their face and insulated by time. There is also a jurisdictional reality. Much of Epstein's early financial activity occurred outside the scope of later federal authority. Even if irregularities existed, proving them across borders and decades posed substantial legal barriers. The record also suggests an evidentiary asymmetry. Epstein's wealth was already normalized by the time of serious scrutiny. Accounts existed. Institutions engaged. Assets were accepted as legitimate by default. Challenging that legitimacy would have required affirmative proof of illegality, not merely absence of explanation. As a result, wealth origin remained peripheral. DOJ documents return repeatedly to what money did, not where it began. Transactions were analyzed for relevance to charges. Assets were cataloged for procedural purposes. The genesis of capital was left largely untouched. This choice shaped the public record. Without a formal investigation into origin, no definitive conclusions could be reached. Silence filled the gap. Speculation flourished where documentation stopped. The official file remained narrow by design. In the DOJ record, Epstein's money is treated as context, not cause. And once framed that way, the central question, where it came from, was never positioned to be answered. By the time serious public scrutiny reached Epstein's finances, the clock had already done much of the work. Financial crimes are governed not just by evidence, but by time. Statutes of limitation impose hard boundaries on what can be prosecuted, regardless of suspicion. Many of the transactions that may have explained Epstein's initial rise occurred decades earlier, in the late 1970s and 1980s, far beyond the reach of most federal financial statutes. Even if irregularities existed, time insulated them. Records disappear. Institutions merge or dissolve. Witnesses die, forget, or become legally unreachable. Paper trails thin out, especially when money is routed through private agreements and offshore jurisdictions designed to minimize disclosure. What remains is often insufficient to meet the evidentiary threshold required in court. This temporal barrier was already formidable before 2019. Then Epstein died. His death had an immediate and decisive legal effect. Criminal proceedings terminated. Subpoena power weakened. Cooperation leverage vanished. Prosecutors lost the central figure who could be compelled, directly or indirectly, to explain financial structures, relationships, and historical transactions. Posthumous investigation is structurally limited. Without a living defendant, there is no plea negotiation, no cross-examination, no incentive for disclosure. Civil litigation can continue, but civil courts are not designed to reconstruct decades-old wealth origins absent a specific legal claim. The Southern District of New York continued asset-related proceedings for forfeiture and restitution, but these processes focus on what exists, not how it was created. The aim is distribution, not diagnosis. This distinction matters. Once Epstein died, the justice system shifted from inquiry to administration. Assets were frozen, catalogued, and partially liquidated. Victim compensation became the priority. The question of origin became legally irrelevant to those goals. At the same time, key investigative tools became unavailable. Search warrants cannot be executed against a dead person's intent. Financial interviews lose their subject. The narrative thread that might connect disparate transactions collapses. In effect, Epstein's death did not just end a case, it closed a category of questions. Whatever explanations existed were either already on paper or permanently lost. Any remaining uncertainty became historical, not judicial. The system moved on, constrained by its own rules. This is why the money question remains unresolved, not because no one asked it, but because the moment when it could be answered passed quietly, years earlier. When official explanations stop, something always fills the space. In Epstein's case, the absence of a definitive account of his wealth created a vacuum, and that vacuum was quickly occupied by speculation, competing narratives, and increasingly extreme theories. This was not accidental. It was structural. The public had been presented with an incomplete story. A man with limited visible professional history, no known flagship company, and no transparent investment track record, yet surrounded by private jets, multiple properties, elite social access, and extraordinary legal protection. When institutions declined, or were unable, to explain how this was possible, suspicion became inevitable. Media outlets attempted reconstruction. Journalists traced donor lists, shell companies, trust structures, and real estate purchases. Each investigation produced fragments, but no comprehensive model. One report would emphasize hedge fund consulting. Another would focus on patronage from ultra-wealthy individuals. None could connect every node. Into this fragmentation stepped alternative explanations. Some narratives framed Epstein as an intelligence asset, funded covertly to facilitate access to powerful figures. Others suggested he was a frontman for money laundering operations tied to international finance or organized crime. Still others implied hidden state sponsorship, blackmail economies, or offshore sovereign funds. These theories flourished not because they were proven, but because they were unfalsifiable in the absence of records. And the internet accelerated everything. Online forums, video platforms, and social media rewarded certainty over caution. Hypotheses hardened into claims. Claims became lore. Context collapsed, replaced by repetition. The more official silence persisted, the more compelling unofficial explanations became. Crucially, this environment blurred an important line: unknown versus knowable. The public often assumed that answers existed and were being hidden, rather than acknowledging the possibility that they were never fully documented in the first place. This distinction matters. Financial opacity does not always imply conspiracy. In elite private finance, secrecy is often a feature, not a flaw. Confidentiality agreements, private trusts, and bespoke investment arrangements are legal tools designed to limit disclosure. Epstein's wealth may have existed largely within this realm, opaque, but not necessarily criminal in origin. Yet because Epstein's crimes were undeniable, ambiguity in one area contaminated perception in all others. The moral clarity of his actions cast a shadow over every unanswered financial question. Institutions attempted damage control by focusing on what could be proven: abuse, trafficking, and victim compensation. But this narrow focus unintentionally reinforced suspicion about everything else. Silence, even when procedural, reads as evasion. By the early 2020s, the money question had transformed. It was no longer merely, where did it come from? But why won't anyone explain it? The absence of answers became evidence in itself, not legally, but culturally. After examining the fragments, the gaps, and the competing narratives, one conclusion becomes unavoidable. There is no single, clean answer to the question of Jeffrey Epstein's wealth. What exists instead is a boundary between what can be responsibly stated and what remains permanently uncertain. What can be said is this: Epstein did not build a conventional fortune. There is no evidence of a scalable business, no transparent fund with audited returns, no documented innovation or market disruption. His wealth did not grow outward in public view. It accumulated inward, quietly, through relationships rather than enterprises. It is also clear that Epstein's financial life was deliberately structured to resist scrutiny. Trusts, offshore entities, private agreements, and informal advisory roles created layers that obscured origin, flow, and ownership. This was not accidental. It required legal expertise, cooperation from financial institutions, and the tolerance of regulators accustomed to elite secrecy. We can also say that Epstein's access preceded his wealth as much as it followed it. Social proximity to power came early, and money followed relationships rather than the reverse. That alone challenges the standard narrative of success. But beyond these points, certainty dissolves. There is no verified ledger that explains every dollar. No document ties his fortune conclusively to intelligence agencies, criminal syndicates, or state sponsorship. At the same time, no documentation disproves those possibilities either. The historical record is incomplete, not because it was erased, but because it was never fully created. And that is the most uncomfortable truth. Some questions surrounding Epstein may never have answers because the systems that enabled him were never designed for transparency. Private wealth at the highest levels often exists outside public accounting, shielded by legality, privilege, and silence. Epstein exploited those systems, but he did not invent them. This does not absolve institutions. Banks processed transactions. Lawyers constructed shields. Social circles granted legitimacy. Each layer chose discretion over inquiry. Each absence of oversight made the next one easier. In the end, Epstein's money matters less for what it bought than for what it revealed. How power can circulate without explanation, how accountability can be delayed indefinitely, and how opacity itself can become protection. The question, where did Epstein's money come from, remains partially unanswered. But perhaps the more important question is why a system existed where that answer was never required in the first place. And that question reaches far beyond Epstein. The documents exist. The questions remain. This channel will continue examining what is public, and what is still hidden. If you value documented analysis over speculation, consider subscribing. More files coming.